Good afternoon and welcome to the Summer 2020 Linneman Associates Capital Markets webinar presented by Linneman Associates and Evaluate Software from REFM. This is your host, Bruce Kirsch, founder of REFM, provider of financial analysis tools and training to the business since 2009. We're very pleased to have an insightful program for you today, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which for those of you who do not know is a strategic and investment analysis advisory firm. We're using the GoToWebinar platform, and there are a couple of housekeeping items to address before we get started. On the audio front, all of the participant audio is muted, meaning we cannot hear you, and that is by design, and that will remain the case through the webinar. If you're attending by computer, take a moment just to familiarize or reacquaint yourself with the control panel items. We're going to be showing the slides, so you don't need to have the slides downloaded. I believe we're having a little bit of an issue with the downloadability, but the slides will be included in the email that gets sent out, which contains the link to the video recording. And we've reserved about 15 to 20 minutes at the end for questions. Feel free, however, to send questions through at any time. Make sure that you do click the send button so that we receive them. And if at any point during the webinar you get disconnected, just reconnect the same way you did initially. Without any further ado, I'd like to introduce the presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, good afternoon, over to you.
Great, thanks a lot, Bruce. Hello, everyone. I hope everyone is healthy and surviving, maybe even prospering in these times. We're as we did at the last session, we're not going to have as many of our traditional charts and graphs. And people say, why not? Well, I can describe pretty much every chart and graph that is, first of all, some of them aren't able to be truly up to date because the data doesn't come out for a month or in some cases a quarter, until a month or a quarter has gone by. And as you know, things over the last 4 or 5 months have changed in real time, and therefore putting up a chart that's a quarter late doesn't help you much. The second reason is I can tell you what all the charts look like. They look normal, 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 good, 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 and then really terrible. And the really terrible happened so fast, and then you get a bit of a comeback. Well, the drop in the comeback happened so fast, the bit of a comeback, that you can't even make out the comeback on the chart. And so the charts themselves aren't all that helpful. Those of you who subscribe to Linneman Letter, I think would attest to that in some ways in the last issue. And we're still going to have that issue, that problem in the next issue. So what I'm going to do is talk through these more bullet pointy charts, which allow me to be more real time in my comments. So let me just step back. And the first slide says, remember when. It was only the end of the first week in March. That's an amazing concept. You know, it's 5 months ago. 5 months ago, unemployment was 3.5%. We had about 157 million people employed, about 5 million unemployed. We had 210,000 new unemployment claims a week happening. We were just thrilled today. I think the number came out, as I recall, at around 900,000. And everybody, yippee, it's 900,000 new unemployment claims this week. And that's viewed as a victory, says a lot. GDP was growing 2.2%, probably trending to about 2.5% per annum. It was the largest economy in the history of the world. It was the highest household wealth ever, longest recovery ever. And while industrial output was flat, it was flat very near an all-time high. We had record levels of tourism, leisure activities, casinos are doing well, movies are doing well, concerts are doing well, theaters doing well, how many had tickets for Hamilton or whatever you were going to see. You all had all these plans to travel around and do great things. Consumer confidence was way above average, not quite an all-time high, but very close to it. Business confidence was high. Single-family starts after an abysmal 12 years was in sight of something normal. You had very few excesses in business or consumer activity. You could always find little things and so forth, but it wasn't systemic. And you had office and apartment and industrial, hotel. The fundamentals of most sector were pretty good. And in my canaries chart, half of the canaries were still alive and chirping. You go to the next chart, Bruce. By the way, we're starting a new one, starting the next issue of Linneman Letter. We're going to start a new set of canaries where they're all alive until we have them dead again as the cycle ends. But essentially, we had about half the canaries alive, but we didn't have coronavirus on our chart back then, and it appeared and killed everything and killed everybody. Go to the next chart, just in up to date. This is actually a week out of date, only a week because we had to have the slide prepared ahead of time. I keep finding it funny. People say, well, all I do is see that chart and the cases keep rising. Well, if you look at a cumulative case chart, or you look at a chart of cumulative deaths, it will always either rise or go flat. And it's kind of a scare chart. And I don't think people understand what a cumulative means. I'm not saying this audience doesn't, but I think a lot of viewers don't understand. So what we've done here is show both in blue, the moving average of new cases in the U.S., which is smoother, and then the daily cases, which is jagged. Depends on when things are being reported. They have reporting coming in on irregular intervals, so that not every day gets the same degree of reporting. So the blue you'll see are cases. The red are the same thing for deaths. And what you'll see is, look at the jaggedy lines and let your mind die, smooth them with the chart behind it, is what you'll see is cases started going up dramatically in mid-March, and about 7 to 10 days later, deaths started going up as well. By the way, deaths are on the right axis, cases on the left axis. So right away, 7 days, 10 days later, deaths responded to cases going up. And then you see cases came down until around the first week of June. And in about the end of the first week of June, cases started going back up. The medical kind of group I'm part of basically is a combination of things opening up, people going, young people in particular, going to the beach and the bar and other things, and protests, and probably more important than protest gatherings, where after the protest is over, when people went back and socialized in their apartment or whatever. And so you see that cases start rising dramatically around the first week of June and have only recently topped off. Only recently have topped off. But what you'll notice is deaths followed a very different pattern. Deaths followed a pattern. It continued to go down. And deaths did not rise 7 days later or 10 days later, 21 days later. You really don't see deaths picking up until about 6 to 8 weeks later. And they have not picked up to nearly the degree they did before. And that's partly we have better treatment, partly we are protecting our most vulnerable better, partly because The big population of cases are among 15 to 45-year-olds this time, whereas back in March and April and early May, they were largely among people 70 and over. So there has been a pickup in deaths, but it's not remotely similar in its pattern to what you saw when everything was shut down. And I think it's important to bear this in mind thinking about hard decisions going forward. Go to the next chart. Where are we today? By most of the metrics I track, some of which are government data, some of which are flash data like credit card usage, people on the move, how many airplanes are mothballed in the desert, a whole bunch of metrics. It appears we hit bottom somewhere around mid-June. That's not to say every indicator hit bottom in mid-June, but the economy seemed to hit bottom around mid-June. At that point, GDP had fallen by about 12%, about $2.6 trillion. And it did that, if you think about it, from the end of the first week of March to mid-June. Let's say the end of the second week in June. So in basically 14 weeks, we shed 12% of the economy. You can think about it as we started digging a hole. The hole is about $2.6 trillion deep. And now we have to fill that hole up before we truly grow again. Until we put 2.6 trillion back in the hole, the economy can't grow beyond where it was. It's growing from the bottom, but not from where we were pre-COVID. We lost about 30 million jobs, net. We probably have today for real an unemployment rate of 18%. The government data, and they will admit this, it's not like anybody is being phony. People don't quite know how to answer the questions correctly if they're furloughed. There are people who are making a lot of money, more money than they were making, employed on unemployment, who are furloughed. Their boss is telling them, when things pick up, we're going to bring you back. They're not answering. They're unemployed, but they are. In addition, you've had people drop out of the labor force. Think of the kids graduating from high school. They're not entering the labor force because what's the point? So we probably have for real an 18% unemployment rate, at least compared to the kind of unemployment we had, the employment levels we had when it all began. Businesses, if they're not dead, are staggering upward over the last 10 weeks. Travel, tourism, leisure, entertainment, most retail, either non-existent or still very weak. Every day that we were shut down cost about $21.5 billion. Every day we were shut down cost us about $21.5 billion. So the way I think about it is we have a $2.6 trillion hole, and we're filling that hole. We bottomed in mid-June. We're filling that hole. But my imagery is we're filling it by the shovelful instead of using bulldozers to fill that hole. And I'll give you another imagery. Somebody was asking me, is this like, the V, the swoosh, the U? And I said, nope. This recovery was not a cyclical drop, and it's not going to be a cyclical recovery. This was caused by, first, the government telling us we can't do things, and second, by things we don't feel comfortable doing. Until we get a world where the government isn't telling us we can't do things we want to, and where we're willing to do the things we did before, this will be a very staggering recovery. And I describe this as the butterfly flying uphill recovery. What do I mean by that? Imagine a butterfly flying up a hill that is $2.6 trillion deep. Will it be a straight line? No. It'll go up quickly and then down quickly and then sideways and backward a little bit. Then it's going to pause. And it's going to go up and down and sideways and forward and backward a little bit and up and down and sideways. Think of a butterfly. It will make it up the hill, but it's not going to be a straight trajectory. It's going to be a butterfly. So I'm calling this the butterfly going uphill recovery. And I think it's a very good imagery. I'm hoping that we'll start filling the hole with bulldozers, but really so far that's not the case. The next page is more for historic, for you to have some benchmarks of what the unemployment rate was. We probably hit in the middle of June. I think we were around 22 to 23% unemployment. And the worst we've ever recorded was in 32, 33 at 25%. You'll see the others. Our unemployment rate is unambiguously, I don't care what the data shows, the real unemployment rate is much worse than during 2009, when it was 10.3 at its worst. During the Great Depression, we lost about 27% of GDP. On an annualized basis, we lost more than that. But since we've hit bottom, we will not lose that much. We've lost the 12% or so that I described in actual. And so those are just benchmarks for you. Go to the next chart. What's the situation report today? Well, for real estate and for other companies that are using bank borrowings, forbearance exists because banks were given massive excess reserves and required to have massive excess reserves by the Federal Reserve, their regulator. And on top of those massive excess reserves they've had incredible amounts pumped into them beyond that. We had QE1, QE2, QE3. We now have QE infinity, which is to say the Fed is going to pump in whatever is necessary in reserves to maintain systemic liquidity. We have very few private real estate deals closing, except those that were negotiated prior to COVID and had non-refundables. Now, I'm not saying there are none, but not many. REIT pricing, depending on the sector, the net asset value implied by Wall Street are down about 10% for warehouse and apartments and down 35% for retail, malls, and senior housing, offices in between, hotels anywhere down from 30% to 50%. The stocks are down more, but that's because of the debt they have, means the fall in value is reflected in the equity going down by more than the asset value. You have consumer and business confidence up, but it's up from the bottom. It's still well below normal, and it's well below where we were in March, early March. Rents, as you know, depending on your sector, are being paid. Industrial and apartments are collecting rents pretty effectively, by and large in the 90 to 97% range. They're collecting their rents. There is this issue of, are you counting using a security deposit as a rental payment? There's a little murkiness there. But industrial and apartment properties collecting rents pretty effectively. Offices generally collecting rents pretty effectively, though if they have retail associated with them, they're not picking that up very well. And where you have a lot of pain is in retail If it's strong retail, they're collecting around 65 to 70% of their rent. If they're in weak centers and they don't have grocery stores, they're collecting much less. So you've got a lot of weakness there. Debt defaults abound. Multifamily, not so much. Industrial, not so much. But in office, in senior, in retail, in various sectors, there are defaults. If it is a bank lender, you're getting forbearance because the Fed says, we gave you all this money to forbear, not to shut people down, as opposed to what they've done in the past, which is pretty much start foreclosure processes. If it's CMBS, you don't have near the forbearance. There's nobody to negotiate with. It's very difficult. It was intentionally structured to protect from negotiation. And there's not much the Fed can do in that regard. So you have a much higher foreclosure process underway in CMBS. Life companies forbearing pretty well if there's a problem. The fact that interest rates are very low allows renegotiation to happen if necessary to keep a loan in compliance. But many of your tenants are gone, just gone. They're gone forever. They couldn't stick around, especially smaller businesses. They couldn't stick around. If you're in the travel, the leisure, the entertainment businesses, and many retailers, you're just gone. And we're going to have to wait for new businesses to come and take their place. That's why this is going to be a longer recovery than people think, because you have to have a lot of new businesses born. It's not just a matter of existing businesses expanding their operation. The graduating class of 2020, that is the high school, college kids graduated in May and June, largely jobless and, for the short term, hopeless about getting a job. And in fact, that's one of the reasons the labor force has dropped. I think this holds problems for the multifamily sector, not in the near term, but as you move forward. Those kids are not coming out of high school and college and getting jobs like you would have normally expected, because as they normally would have gotten those jobs, they would have rented your apartments. Since they're not getting those jobs, they're staying at home. In the short term, that has very little effect on apartments, but it does have an effect as tenants leave and you don't have that fresh blood to replace them. You have a massively increased role for government, a role that most of us could never dream of. I remember I was in a conversation when we first heard about Wuhan being shut down, and the people I was chatting with, we all said, well, you can do that in China, but that could never happen in Italy or Germany or England or the United States. Well, it can. We saw it. We're still seeing it in many cases. And government has bought many corporate bonds. They're going to end up by, there's just a lot. And by buying a lot of corporate bonds, in a way, they're buying corporate equity, because by supporting those bonds, they make the equity look more attractive, pushing out investors from from corporate bonds into corporate equity. We have social unrest. On March 24, I said if we keep people locked up very long, there will be social unrest. I had no idea what the trigger would be. I had no idea what the catalyst it would form around. But every society has fault lines, and if you take away jobs and you take away hope and you make people anxious and you lock them up under house arrest, tensions rise. We still have COVID. You saw the chart. You know what's happening in that regard. And as I said from the very beginning, if you've listened to me, the hopes for treatment are higher than the hopes for vaccine. but both of them are going to take some time to get there. And we still have enormous political uncertainty, kind of unprecedented political uncertainty. People ask me, well, who's going to win the election? And I say, well, I'm not a pundit. But the one thing I would forecast is this election isn't going to be over until it's over, because you have no idea what could still happen in terms of the economy, the disease, the medical breakthroughs, the lack of medical breakthroughs, the social unrest, et cetera. And you start mixing all those together. Tremendous uncertainty politically. Just do the math, okay? We will have about a $10 trillion cost, I estimate, associated with the COVID experience in the United States this year. That's going to be comprised of the $2.6 trillion we just talked about that we lost during the shutdown period, and about 7.4, maybe 8, who knows, 8 trillion of we're taking on additional government debt. We're borrowing from the future to pay now. When you add those together, around $10 trillion. If that $10 trillion economic cost saved 1 million lives, it comes out to about $10 million per life. That's just math. We know that about half of those, a little higher, about half of those who had died would have died within the next 5 to 12 months. Not good or bad, just factual. So that said, well, we kind of maybe extended that person's life. They didn't die of COVID, but they died of something else 6 days later, 6 months later. So you'd say if half, you'd take it from 10 million to 20 million per life. By the way, as an aside, you might say, remember I said there's two issues going on here. One, government won't let us do things. The other is we won't let ourselves do things. And one of the things you might say is, well, wait, that $10 trillion cost is not all due to, quote, the government. It's due to the combination of the government wouldn't let us and we won't let ourselves do it. So it is fair to say that maybe half of what that 10 trillion is due to we won't let ourselves do it, as opposed to the government wouldn't let us do it. And if you, depending on what number there, you would adjust accordingly. But if we only saved 100,000 lives, and 100,000 lives is a lot of lives, and those are lives of people who weren't going to die in the next 12 months. Those are lives of people who are going to live a long time. If all we saved was 100,000 lives, the cost goes up to about 100 million per life saved. And then half of that number, by the way, if you say half of that is due to the government decisions and half are due to us. And I just use these as benchmarks. OMB has historically used 7 to 9 million as the value of a life in their cost-benefit analyses. Killed in action, about 200,000. Legal judgments, 1.5 to 3. And lifetime earnings typically run $1.5 million to 2.5 million. You can each judge for yourself whether, quote, it was worth it so far. I mean, I have a personal view. My personal view is I don't know how we can afford it. If we're going to say a life is worth on the order of somewhere between 20 and $100 million, and lifetime earnings are only on the order of $1.5 million to $2.5 million, how could we ever afford that? We don't do it for cancer. We don't do it for heart disease or diabetes or the flu or any other disease. We didn't do it for AIDS. We just can't afford it. But that's my personal view. All I'm doing here is presenting you the math, and you can think about it. We all as citizens have to have some view about that because it is about a trade-off. You may not like making trade-offs. None of us like making trade-offs. But life is about trade-offs, and there's a political decisions that are being made, need to be made going forward on how much do we restrain versus how much do we open. If we open, there are going to be more cases. There's going to be more cases. There's going to be more deaths. So if we shut down, I had a conversation this morning with someone saying, yes, basically they wanted a complete shutdown. And I said, well, if we completely shut down, we'll never get a cure. We'll never get a cure. A cure is not going to come from an economy that's shut down because you can't afford it. The cure is not going to come out of Sierra Leone. The cures are going to come from rich countries that have vibrant economies. We need to keep an economy vibrant for many reasons, not the least of which is to pay for the research and innovation. Go to the next. What do I see for the next 12 months? Like I said, it's a butterfly flying uphill. I don't see how it's a quick recovery. Butterflies don't fly that fast, and they don't fly that straight. They fly too circuitous. We are going, in many cases, of replacing non-existent businesses, so we have to get somebody to recreate a business and then get it back up to 100 where its predecessor was. That takes a lot longer than going from 95 to 100. This is a very unique situation where a lot of businesses have disappeared. And if you think about air travel, international travel, businesses relying on that, concerts, theaters, I'm just using the obvious examples. It's going to be very hard for a lot of those businesses to come back for a while. I think it takes the butterfly probably until mid to late 2022 into 2023 before it gets back to where we were, before that hole, that $2.6 trillion hole is filled back in. Now, during that time, we're growing. But remember, we're just getting back to where we once were at the end of the first week of March 2020. International borders going to be among the last things to open. You can even see it inside the country, which is, gee, I don't want people from Florida to come in, or I don't want people from South Carolina. We've never had that kind of attitude. Europe is struggling with it mightily. So I think international borders will be among the last things to recover. Nationalism is going to increase logically because I want it produced here. Everybody wants the vaccines produced here. Everybody wants the medical stuff produced here, wherever here is. I'm not even sure that I don't want it produced in my state because I don't know if I can trust those New Jerseyites across the Delaware River. So you're going to see increased nationalism. You're going to see increased, every economic downturn, unfortunately, is associated with a rise in anti-immigrant attitudes. And it's always they're taking our jobs, they're taking our livelihood. Whereas in a very robust and aggressive economy, they're providing us with labor. In a down economy, they're taking our jobs. So we're going to go through a period of increased nationalism. And I think that's true no matter who's elected, by the way, whether it's Democrats, Republicans. Remember, historically, the Republicans were the party of immigration, and the Democrats were historically the party against immigration. That's kind of been put on its head in the last 3.5 years. But I think it's irrespective of who wins, that will be the case. You will see, especially for pharma and for medical, shortening supply chains. You're going to see a lot of studies of shortening supply chains, but it's going to really happen with medical and pharma. Massively increased role of the central government. Probably that's going to be, this is not going to disappear in a year or 4 years. Again, irrespective of who's elected and what the Congress is, this is not going to turn on a dime. This is a pendulum movement. Interest rate repression will occur. Interest rates, historically, you used to think about, prior to 2009, interest rates were determined by a profit-driven investor selling to a profit-driven investor. Interest rates for the last decade and certainly for the last 5 months have been determined not by profit-driven investors, but by government interventions, central bank or sovereigns interventions. And they're repressing interest rates. In the short term, that allows people to survive, not big costs to it. There are a lot of benefits. However, a la Japan, if you repress rates forever, you misallocate capital, you end up giving too much to government, you end up giving too much to those that already have it, and not enough to those that want it with new ideas. And that will ultimately slow growth. If I had to guess, we're around 18% unemployment today. We'll be at about 12% in April 2021. We'll be around 5% by around April 22. But I'm a bit optimistic on how the butterfly is going to go. I think we'll still have COVID. And I've had this view that either we'll have medical solution within 2 years or we're going to go back sort of to our lives because we aren't going to shut down forever. The other thing I'd say is shutdowns eliminate the incentive for innovation. So if you don't allow theaters to be open, you don't allow innovation on how to make theaters safe. One of the things you do by opening theaters is you encourage entrepreneurs to figure out ways to make them safe because they can make a lot of money. So with Bruce, I'll stop there for a moment. And
yeah, we're just going to take 60 seconds to see how many folks are in the various rooms across the country and the world. If you don't mind, just fill out the single question and submit it, and then we will get back to the presentation. We'll take another 5 seconds here. So we get to 80% voting. And we're real close, so I'll just close it out now. And
great. Well,
yeah.
With that, Bruce, I'd go to the chart that says a word on oil. Look, two things happen coincidentally at the same time. One, a cartel collapsed, totally because of U.S. fracking. Also, because of COVID and government actions and individual actions, demand collapsed and prices just plummeted. It will be hard to fully reassemble the cartel as long as fracking is viable as a threat. They're trying to put the cartel together, but it'll be hard with that supply source there. Oil prices, I think, are stabilizing. They're going to be in the 35 to maybe 45 range. That is to say, they could occasionally bounce below that or above that. That kind of keeps it in the range where fracking is there, but it doesn't flood the market. If the price gets much higher, fracking floods the market. Those prices hurt Texas and Houston. It helps the rest of us in the economy, especially if we drive and fly. By the way, I get asked a lot, the next chart, how do we repay this government debt we're taking on? And let's say it's $8 trillion. I'm just taking a number. I told you I thought it'd be about $7.4 trillion. Let's just take $8 trillion. How is it? Well, government debt is in high demand from sovereigns around the world, including our Fed. If we matched our borrowing by borrowing 30 years, we can do it at a cost less than 1.5% per annum. And that's $120 billion of additional interest payments. And in fact, the interest rate's even lower than that. But let's just say $120 billion in additional annual interest. That's 2.7% of the 2019 federal budget. That's a year or two growth would make that up. So it's, I don't want to say it's trivial. If we're getting our money's worth by reducing the pain and suffering of a generation, great. If all we're doing is wasting money, it's never good. But certainly we could afford it. The other is, if you ask about what's the perpetuity value of the U.S. economy, what's the present value of U.S. GDP, you're going to come up, depending on discount rate and growth rates, you're going to come up with some number going close to 1,000 trillion, close to 1,000 trillion. Let me just say, it's 800 trillion to 1,000 trillion dollars is the present value of our economy. 8 trillion is like 1.5%. So all we did was move 1 to 1.5% of the total value of the U.S. economy from the future to the present. And as long as we're getting our money's worth, that's great. Higher taxes are to come to close that $120 billion, but you can see they don't need as much higher taxes as you might first think if you finance like this. Now I'm going to move very quick. I know I'm running a little long. So the next is apartment markets. Collections are good. People are working with their tenants. You probably won't recollect the rent you forestall. Be ready that if things fall off the table, you get forbearance, especially from Freddie, Fannie. Obviously, defer your CapEx. You're going to see your occupancy slide because of the class of 2020 not being there, and high unemployment means some people, as their leases expire, don't have jobs and are going to move back home. And so I do see occupancy falling through the year, could go as low as 88% occupancy. I don't think it'll quite go that low, but not a bad thing to play through in your models what happens if it does. And by the way, there won't be a lot of foreclosures because banks will forbear, life companies will forbear, Freddie, Fannie will forbear, and I think they've got good enough income. There will be a bit of a move to the suburbs because young people who were thinking about moving in the next 3 years will all move in the next year. Why wait it out? Get yards and all those things for my kids. Why wait the extra year or two? The cities are largely shut down socially anyway. So I think you're going to see that happening. Office market collections are decent except on the retail space. You've got a lot of rental forbearance. Because these are corporations, you probably will collect a fair amount of that. You've got a lot working on loan forbearance, obviously deferring CapEx, not signing a lot of new leases. There's not a lot of new activity. There are some bankrupt tenants, especially those that were financed by bonds and those that had pure cash businesses. There's a very small number of forced sales, even smaller unforced sales. Why would you put it on? And there's going to be tenants needing more space because the shared work environment is just not viable in a COVID world. So I expect over the next 5 years to see space usage on average start rising 5 to 20%. People aren't going to work from home forever. You can maintain a good company remotely. You can't build a great company remotely. You can't grow a great company remotely. University types and writers write about this. They're kind of antisocial. They need that creative isolation. They work from home. They don't really understand what the collaborative environment is like and the importance of workspace. A hotel outlook, it's difficult. Banks are forbearing, but not CMBS. Very difficult to get CMBS. RevPARs are down anywhere 60 to 80%, some more. Some are completely shut. By December, it will improve to where RevPAR year over year will probably only be down 50%. Airbnb suffering a lot because you can't guarantee sanitation in the same way. This is probably a 4-year recovery path. This is a deeper hole, if you will, and the butterfly's got a lot farther to fly out of this sector. It really needs some type of medical or technological breakthrough vis-a-vis COVID, not just for the government to say you can travel if you want, but it needs us to feel good about traveling again. Retail market, go to the next, is you're working with tenants. If they're major tenants, you'll probably collect the deferred rent. If they're restaurants and the like, you're probably not going to collect your deferred rents. You're getting lender forbearance if the lender's a bank, not if it's a CMBS. People are deferring CapEx, they're deferring projects. Occupancy is being hurt, particularly in the weakest center. That makes the stronger centers ultimately stronger. And just think of the hair salon that closed in the weak center. It's not going to open back up in the weak center. There's going to be, that business is going to end up in the stronger center. Groceries online was shown during the shutdown. People will do it. It's a disaster and you can't make money at it. And until you can make money selling groceries online, it will always be a niche business. And everybody talks about how they're going to make it work and it's convenience, but if you can't make money at it, and it doesn't even come close to making money. And the other interesting thing is people say how much online sales rose. They fail to point out that the rise was a very small part of total decline in retail sales. That is to say, most resale sales did not occur because bricks were closed. Industrial, you're in good shape if your tenants are online. Traditional boxes, boxes with traditional tenants hurt more. If you're in the import-export zones, you're hurt because import-exports are both down. You don't have as many boxes coming. People are forbearing with some tenants. On the other hand, when you read about the bankrupt retailers, they had boxes being stored in warehouse space somewhere. Lenders are forbearing, again, if they're banks, not if it's CMBS. I can't see how the industrial market doesn't suffer some going forward, because in a market with 10 to 15, 20% unemployment, there's just fewer boxes needed. And yes, you won't suffer as much, but there has to be some suffering. This will be a 2-year journey. And then go to the next. So what do I think? Butterfly, 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 right? Think of the butterfly flying uphill. There'll be more COVID cases. There'll be more deaths. There's going to be more deaths associated with heart disease going forward. There are going to be more cases of Alzheimer's going forward. There's going to be more cases of cancer going forward. It's part of life. It is here. It's here until proven otherwise, just like we've dealt with other diseases and other illnesses that are horrible. The medical outlook, based on all the group I'm in and stuff I read, is hopeful but very uncertain, very uncertain. I keep reminding people it is hard for any business to do well in an economy where the unemployment rate is 10% or higher. And you're seeing that with even these strong companies like Facebook and so forth. Their ad revenues are going down. People aren't spending as much. If they don't spend as much, you don't advertise as much. So that's going on. The Fed will keep rates low probably for a decade. And not just the Fed. Around the world, they're going to provide all the liquidity and all the support that's necessary. And in fact, you could end up in a very odd situation. You're getting more money is going to be spent by the government, and the longer this goes, the more political it's going to be in its spending pattern, rather than saving a generation. The spending initially was saving a generation, and every day that goes by, it's more about political agenda of both parties and every individual. construction pipeline going to fall. Development pipeline's going to fall. I think by historic standards, you're going to see construction costs over the next 24 months fall by 10 to 25%. That happens every downturn. Happens slow in the beginning and then picks up speed. Right now, there's still a lot of projects being worked on that were started prior to all this. Well, they still are keeping the trades busy. Once they're done, they're not so busy. Going to have large bid-ask spreads on property, and those large bid-ask spreads are going to keep transactions from occurring. If you do a transaction and you have long-term debt, you're going to have to figure out, can I sell the property with the debt? Because otherwise, the prepayment mathematics associated with penalties that are calculated on short-term treasury are just impossible. And the opportunities that may arise this time could be very slight. In a world, if we do as Germany did, Japan did, France did in the past, and we forbear, the number of opportunities will just be a lot less. So the good news is, if you're an owner, there's forbearance. The bad news is, if you're an investor, there's forbearance. And so that pricing discovery is going to be forestalled. And I think there's a good chance there will be very few opportunities in the traditional private market because of the extent of forbearance. Now, there'll be some related to CMBS in particular circumstances or places that need large operating capital injections. So with that, Bruce, I'd stop, and I know I ran a little long. We have time for a little bit of questions.
Absolutely. Thank you. Absolutely. Thank you so much, Peter. So we've had several participants ask about the renewed attractiveness or increased attractiveness of suburban life, working in suburbia, living in suburbia, as opposed to the massive trend that we've been having for so long towards urbanism. What are your thoughts on that? Is this going to be something that's sustained? Is it just a blip? What do you think?
All right, so a couple of factual statements. First of all, the suburbs never lost their popularity with people. The suburbs were still, all you had to do was look at census data, the suburbs were still growing faster than the cities. They were still attracting more young people than were the cities. It's just that they were doing so to a lesser degree than prior, and that's why the cities made a comeback. And you combine that because people have fewer children and this and that. So I think factually you have to remember that the suburbs never lost their attractiveness to people. It's now just a matter of relative. And I think it's hard to deny, and I've lived in city my whole life, it's hard to deny that suburbs look more attractive. It's nice to have a backyard if you can't go anywhere, especially if you have children. It's nice to have big parks close by if you can't go to things. It's not as much fun in the city when there are no concerts or no restaurants or no ball games. I mean, I lived in the city because I love going to ball games, and the concerts and the theaters and the restaurants, well, they're all closed. So that makes it less attractive. There's no doubt that the riots make it less attractive. There's no doubt that there's more crime on the streets. And you see it in the shootings data around. That has a negative effect. So I think what you're going to see, Bruce, is the young people, and by that, think young with children, are going to leave the city or not come in if they're thinking about having kids in the next year or two when they otherwise would have for a few years. I think that part is driving to the suburbs there. I think on the other side, it is the older population, let's say 55 and above, who's going to be very sensitive to tax burdens much more than the younger. They're going to be much more sensitive to safety issues than the younger. The younger are out partying anyway. They're invincible. The older people, let's say 55 and over, much more concerned about security issues during the day. And there's no doubt that the images one sees, or if you lived in a city, it wasn't like you saw images on television, you saw them downstairs, you couldn't go out. There's one other, I was saying to somebody that protests are wonderful for good causes, there's no problem. But in a way, it's like if you live in the suburbs and you're not where the protests are, they're good, just like tourists are good if you live in the suburb because they bring activity to the economy and so forth and so on. If you live near tourists, it's funny, everybody who lives near the tourist sites generally says, I don't like the tourists, I don't like the tourists. I like the fact they bring economics, but I don't like the tourists. And in an odd way, you can say what you will about how great protests are, but if they're occurring in your front yard, literally your front yard, and that's largely been in the cities, day after day, week after week, the streets are closed, you don't know if they'll stay peaceful or turn the occasional violence, you just don't know. Those are tricky. Those are truly tricky. So I think the arc of history is pro-city, but the short term, I think it's kind of a dark period, a cloudy gray period in the city for the next 5-7 years. Doesn't mean they disappear. I think the real key for the city is how they respond to the challenges they face today. And I'm not a New Yorker, but if you take the way that Bloomberg responded to things as a model, the cities will do okay. And I'll take my own city. If you take the way Wilson Goode, a former mayor of Philadelphia many, many years ago, good man, by the way, but if you take the way he reacted to problems, it'll be a disaster for cities. So the cities are at a time where decisions are going to matter. Their fate is not sealed either way.
Thank you. So we've had a couple of people write in about how on earth did we miss this, right? I was updating some presentation materials the other day, and lo and behold, I didn't have a bullet point for pandemic, and I cannot be alone, right? I mean, we have so many bright, hardworking people in commercial real estate around the world, and the bullet point for pandemic as a risk factor for the investment committee presentation or the credit committee presentation didn't exist. Well, now it's on your canary slide. Now it's on everyone else's slide deck too. What could we possibly miss going forward now that that's...
By the way, just to be clear for the record, those of you who have followed me for years remembered every seminar I gave, I spoke 5, 10, 15 minutes about the danger of novel viruses, right? So I was unusual. Of course, nobody who really focuses on the once in a lifetime events. And by the way, I'm 69. It is once in a lifetime. And I hope it's once in a lifetime. I don't want it to be twice in a lifetime. And yes, you can say there was SARS and but come on, it was to this magnitude once in a lifetime. The problem, I'll answer the question in a different way, Bruce, is that once in a lifetime events are fundamentally impossible to predict because some of them are new and some of them are so old. Remember, once in a lifetime, right? Some of them are so old that you forget them. You forget their lessons, right? And we saw the little of that of the financial crisis vis-a-vis the Great Depression, beginning of the Great Depression. Who remembered that lesson, right? It was a once in a lifetime thing. The attack on the World Trade Center and the Washington, D.C., who remembered I know people remember Pearl Harbor, but I mean in the sense of policy, of protecting our buildings in quite that way. Who remembered, right? Once in a lifetime events are essentially impossible to predict. However, it is important to remember once in a lifetime events happen about every 8 to 10 years. It's just that it's a different event that occurs every 8 to 10 years. It is not that once in a lifetime events are rare. It's that a once in a lifetime event is definitionally rare. So what's out there? I'm not arrogant enough, and I'm arrogant. I'm not arrogant enough to say I know. It's a once in a lifetime event. That means almost certainly it has not occurred in my lifetime. If it has not occurred in my lifetime, it is very hard for any of us to really grasp it as a real threat. Not a threat that you can come up with in a classroom, right? But a real threat. You know, take, for example, revolution. Out and out revolution. Armed fighting in the streets with weapons and tanks and so forth. It's just impossible for us to really imagine that. That's why movies about it are so fascinating to us. Could it happen? Sure. It's happened all over the world, all throughout history. We're not immune to it, but I couldn't predict it. Wouldn't be what I'd predict.
All right, thank you. Unfortunately, we're not going to have a chance to get to all the questions that came in. I do want to make folks aware that what we talked about today is really just a digest of what's covered in much more detail in the Linneman Letter, which is a quarterly hard copy subscription from Linneman Associates. You can learn more about that at the Linneman Associates website, along with other offerings, educational and otherwise. The website is linnemansociates.com. And if you want to know more about REFM, our website is getrefm.com. I want to thank everyone for participating today, and please stay safe, and we look forward to seeing you again next quarter. Thank you, Peter.
Many thanks. Bye-bye.